got a lot to cover today, so we're going to start, and we're actually going to start with the lecture today. Okay, we'll circle back to current events, but we're going to start with the textbook material because it's important for me to cover that. Now, if I don't have questions, this is stuff that I like, and I talk about it forever, but I'm not going to talk about it forever because this, to some extent, is a little bit outside the realm of real estate, and so I'll go over the important stuff, and then beyond that, if I don't have any questions, then we'll move on to other stuff. I just wanted to show you, I kill the 2 hours that while I'm here, I always bring something to do. So today you know, you always have to be replacing your investments. You know, you always have to be, you know, buying and selling. So I'm always looking for stuff, and so I've got a list here of things I need to look at, and so, Chris, how are you? And I'm gonna. So I start, I start looking, and so I found a company today. It was very interesting. So this is a REIT. Oh no, it was here. So this is a REIT. So going back to the issue of can you be insolvent and still be a business? So I found this REIT. I don't know anything about it. It's a company called Unity, and I'm like, what the hell is this? So Unity is a company that, so, you know, REITs, so passive income, right? Passive income, like rent is passive income, right? So, so we've talked about, there's been several companies that have elected REIT status that are not traditional real estate providers, but the more common ones, for example, there's 2 that own jails, but they don't have a management contract for the jail. So there's an entity that manages the jail, and then there's an entity that owns the facility. I think one of them is called Core Civic now. It used to be called a very sexy name, Corrections Corporation of America. The other one's got another name called Geo Group. I think they're headquartered up the road somewhere in Boca or somewhere like that.
I think the opposite. The name used to be Core Correction Corporation.
No, it used to be CCA. It's Core Civic now.
It's Core Civic now.
Yeah. So it was called Corrections Corporation of America. So those are. But then there's been some other ones also, right? So, Chris, if we could keep it to notes today, not, please? Okay, no, you know, other things. Thank you. What do you call it? So there's some other ones like towers, right? You've seen the one with towers for like the American Tower for telecommunications. So there's a couple. There's one called High Power now, which owns transmission lines. And then there's another one called Core Energy that owns. It's kind of like what an MLP does. It owns like the pipeline or the storage facility in an operating company. Now the one I saw today is Unity. They're buying fiber. Anyway, the reason I bring it up is. So I look at it, and I look at the balance sheet, and so you look at the problem is this thing's too big. But you take a look at the balance sheet, right? Take a look at the balance sheet, and it's got $4 billion worth of debt, and has negative net worth of $1.4 billion. And I'm like, how the heck are these people in business? Well, they're in business because it's all long-term debt, but. And they're actually buying another company and issuing another $450 million worth of debt. They announced this today, or of equity they announced today. So I just thought it was kind of interesting that you can, in fact, be insolvent. This company is insolvent, but it's very much a business. So, and it's a REIT. So, I mean, even crazier than that, it like, let's see if it makes any money. I didn't even get that far because when I had the balance sheet, I was like, okay. So, yeah, it looks like they only lost $5 million for the year. Now, what saves all these companies is, if you take a look at the depreciation charge, right? Depreciation and amortization. If you take a look at that, that's like $300 and something million, right? 376 million. So in fact, it loses 5, but it has a positive cash flow or operating cash flow, or FFO if you want, of $870 million. Now, with that, they got a service debt and all that. But anyway, I thought it was kind of interesting that.
It just seems contradictory. How can some company be out there and be completely unregulated,
Well, it's not that it's unregulated.
running their balance sheets like that?
Well, nobody forces them to buy the stock. So I don't have time to go over all this. So one of the other ones I went through is a company called Seadrill. So when I do these screeners, I'm looking for deep value. Now the problem is, so I'm finding companies that have huge asset bases, they're trading for peanuts. There's a reason why they trade for peanuts. Seadrill is part of the other thing is they get all these sort of convoluted structures. A company called Seadrill, there's a company called Seadrill Partners, and there's a company called North American Drilling Partners. They're all controlled by the same guy. But it's like a $4 billion asset conglomerate. What they do is deep water drilling. And they've got like $1 billion of cash. But they've got like $3 billion of debt. And it's all due now. And so that was a pissing contest between the creditors and a controlling shareholder. And they're trying to get the guy to put more money in. And why do I bring all this up? Because there was a press release they put out yesterday saying, look, we have restructured our debt. We've extended terms. They've got like $2 billion of it was due before the summer. And so we've extended it till August. But then they go on ahead and say, well, we can't make any prediction on this. What we can tell you is that we believe that the creditors will be deeply affected and may lose all of their value, and the shareholders will be deeply affected and will most likely also lose all of their value. And so the only way we're going to get out of here is if we restructure, and we're already telling you, buyer beware. If you buy the stock and lose it, you lose your investment. Don't say that we didn't tell you. Okay, so, but when a guy, now that could be a guy playing hardball. That could be the guy, saying, what to the creditors? Okay, sue me, because if you owe somebody $3 billion, what are they going to do with the oil rigs? The things are leased, they're producing cash flow. It's a structuring issue. But these people want to get paid, and they want to get some of that money, So, anyway, Dr. Wertzer. So, the reading material this week was. They were chapters 6, 7, 13, and 14. And the sort of general theme of those was investment banking firms and the equity markets. Okay, investment banking firms and the equity market. So I want to cover that early today so that we get the textbook stuff out. We've got 3 presentations. Speaking of that, I've not seen an outline from you. And you guys have a paper due in 2 days.
I was going to do
Did you?
it. I will.
You will. It was due a long time ago. Yeah. Because how are you going to start on a project in a day when you needed to have the outline, approved? But, and you got to present next week. You got to get the paper in early, okay? You got to get the paper in early. Hello, Olivia.
Hello,
Good afternoon. So general things, investment banking, asset management businesses. So what's an investment bank? How do they generate income? How do they operate? What services do they provide? Talks about, specifically, and we'll go through some of these, what's underwriting, what's advising, what's a broker-dealer function, etc. It talks a little bit about, the chapters also talk a little bit about an initial public offering. They talk about, ongoing registration. They talk about shelf registration. They talk about non-publicly non-public issuances or issuances that are exempt from public registration. Okay, and it gets a little bit more into the sort of mechanics of the markets. What are the markets? How do they work? How are trades executed, et cetera, et cetera. Now, the problem is, this is all, actually it's not a problem, this is all sort of an evolving area, especially when we get to the whole segment related to markets. We talked about something called dark pools the other day. That's not in the textbook, because that's sort of evolving. And so, when we get to that, I'll kind of conceptually give you the history of how we get to the price discovery and market clearing transactions of equity instruments, but you got to be on top of it because this changes every day. It really is, technology has just brought a lot to bear on how equity or financial instruments that essentially represent the residual interests in company are traded. Okay? So, with that, investment banks. So investment banks are not commercial banks, are not depository institutions. They don't take deposits and they don't make loans. Now, they may make loans, but they don't take deposits. So we say the business of a commercial bank was take deposits, make loan. How did they make money? Spread, fees, right? Basically, that was basically it, right? Investment banks do a lot of different things. I'll go through all of them. I sort of wrote them here so that I wouldn't forget. And we're gonna, some of these functions, they'll play more than one role as it relates. You're going like this, we'll get to that. We'll mention them all. So some of these functions essentially cover 2 or 3 of the areas of their business line or business offering, okay? But first and foremost, I'd say they are underwriters, okay? And closely thereafter, they are broker-dealers, or can function as broker-dealers, okay? They are advisors, primarily in mergers and acquisitions, but it could be in a lot of other corporate areas. We'll talk about those. They are asset managers, so they don't take deposits, but they will take your money and help manage it for you, okay? They are innovators. We've talked about some examples in class. We can talk about a couple later today. And then they are also merchant bankers, in which they operate or function and invest on their own account. So we had said commercial banks really were historically prohibited from trading with their balance sheet. Investment banks are different, and that's kind of the major distinction there. They don't take deposits, and they're kind of free to play with their equity, so to speak, okay? So, historically, we kind of talked in class about, we talked originally how we had a Glass-Steagall Act, and the Glass-Steagall Act basically said, in 1929, it separated 3 distinct areas, right? Investment banking from commercial banking, from insurance activities, right? And Glass-Steagall kind of said you can't, if you do one, you can't do the other. But as the years went on, and ultimately, so there was a creation of this whole Bank Holding Company Act, okay? And then with the Financial Services Modernization Act of 1999, okay, which basically was sort of created or passed for the purpose of letting Travelers and Citigroup merge. We kind of formally came under the umbrella, and we can now have bank holding companies that operate investment banks, commercial banking activities, and insurance activities all under one roof. So when we come to, by let's say 2005, 2006, most major investment banks are affiliated with a major financial institution. For example, JP Morgan, which was never really a commercial bank per se, but they did become one when they acquired, Chase, and the Chase manufactures Hanover, a chemical bank, sort of commercial. But heretofore, they really were not. But JP Morgan had the investment in commercial banking activities. Citi, right? And if you think more in the international realm, banks like Deutsche Bank, right? Barclays, HSBC, right? Credit Suisse, etc. So most investment banking activities by 2005, let's say, were intertwined with a commercial bank outfit. There were, I think, only 4 major pure play investment bankers left at that point. There was Morgan Stanley, Goldman Sachs, Bear Stearns, and Lehman Brothers. And so, well, and we could say,
What was the distinction there?
Merrill Lynch, these were pure play investment bankers. Pure play. So they strictly were investment bankers, okay? Now, what happened? Merrill Lynch ran into problems, and what happened with that? That came to B of A, right? Bank of America, or BAC, I guess is their symbol. So Merrill Lynch became a part of Bank of America. What happened to Bear Stearns?
Did they close down?
Well, they started closing a lot of stuff. This stuff kind of, JP Morgan came in and took a bunch of that. What happened to Lehman Brothers?
They got wiped out, right?
Yeah, I mean, so there's still some of that still alive in bankruptcy, but that got wiped out. And what happened to these two?
Goldman's still there, right?
But what are they?
Still
Chris, what are they? You probably know that.
What regard? I mean, you're just investment bank. I don't know how you want to say it.
Well, so what happened is in 2008 when we have the crisis, you probably remember something called TARP, and you probably remember something called TALF, and these were all financial assistance programs that the Fed or different government agencies provided. Well, one of the things that they came in and said, look, if we're going to throw financial institutions a pipeline, then we'll do that, but you have to become a bank holding company and you have to be subject to regulation. And so what's happened is both Morgan Stanley and Goldman have elected to be treated and got regulated as bank holding companies. So we no longer have any pure play investment banks left in this country. Now there's some small ones out there. Look, there's one based in Miami called Ladenburg Thalmann. It's controlled by Phil Frost, but it's a publicly traded, but it's like a third tier, you know, they'll do like an IPO for like $25 million, you know, they do like really small companies. There's a bigger one, which is sort of pure play in Tampa called Raymond James. Some of you guys may have heard of that one. They recently bought one called Morgan Keegan, which had been freestanding and it was part of Regions Bank, and then Regions Bank sold it. But you know, the reality is you've got 10 or 12 big banks left, and they are all either directly bank holding companies or part of a bank holding company group, okay? And the distinction
So
there...
what's that top square right there that you just wiped up, the one on top?
Bank holding company.
Bank holding.
And what happens is, so what's the big operating, you know, the big operative there is that now they are under the supervision of the, you know, the federal regulators, okay? And so, because, you know, there's the concern that, you know, they now have FDIC protection. What happened is these guys started financing themselves by taking deposits. They started doing like big CDs at low rates, guaranteed by the FDIC, and so, you know, they can contaminate the system. So now they're subject to regulation. And so that's how they work. Okay, now what do they do? What do investment banks do? You know, I'm going to talk about these two sort of first, okay, together, which is underwriting and broker-dealer activities. Again, some of their functions sort of, you know, cross lines, but so they probably first and foremost are underwriters. And so what's an underwriter? Olivia, what's an underwriter? Not an undertaker.
They're looking at the financial.
Well, they do that. Yes, they do look at it. Yes.
And then they make the decisions.
To do what?
Increasing
Well, so they do opine on value, they do that, but there's a big sort of function of underwriting. When we underwrite a real estate deal, what do?
Basically, you're vetting it, they're just vetting whatever.
You're evaluating the conditions and ultimately arriving at a value, okay? And then with that value, you're either going to invest or not invest, or find someone to come in and invest or not. Well, underwriting stock is no different. You have an independent entity which goes to a company, or better yet, a company. Angelo has a company, he wants to raise capital, and he goes to an investment bank and they underwrite the deal. They look at the, they do a model, just like we would do in real estate. They do a model, they forecast, right? And then using a discounted cash flow process, come back and value what they think that business is worth. And then based on that, what do? They say, okay, we can help you find the funds or not, or we'll talk about the different underwritings that exist, and then they'll help with that process. So underwriting is basically the process of evaluating that company's value, right? Evaluating the operations, forecasting the cash flows, and arriving at a value. Now, when you underwrite, you typically enter, there's 3 or 4 major type underwriting deals. There's one called best efforts, okay, and let's call this guaranteed, okay, it's fixed, okay, and then we've got a standby. Underwriting, okay? And we're going to talk about all these in a second, okay? So, the first one is where essentially the bank comes up and says, look, we think that your company's worth $500 million. We think we could sell. For some reason, IPOs always trade at what price? What price do IPOs come out at? What's the magic number? No, it doesn't depend. All the IPOs, everybody comes out at a price, more or less.
10, 12 bucks,
Chart door number 2.
15.
15 is like the magic number. Everybody tries to price at 15. So it's a game. You can create as many number of shares as you want to work back to an enterprise value. Or starting with an enterprise value, you can issue the number of shares that you want to get back to a $15 per share price. Now, where it goes there from there forward, then it depends on the market, right? It depends on the supply and demand. But basically, a company could come in and essentially an investment bank could come in and guarantee your underwriting and say to you, we will buy from you the totality of the shares you're going to issue. You're going to issue 100 million shares, they're worth 15 bucks a piece, so that's $150 million. We will guarantee you at issuance $150 million. Now, that's a great deal for the company, right? They assume no risk. Somebody has bought their issuance, right? The flip side of that is an investment bank can come in and say, look, we're going to do a best efforts, and we're just going to work for a fee. What does best efforts mean? Best effort says, look, we think it's worth 15, but we're not going to guarantee anything to you. And so what we're going to do is we'll use our marketing machine, and it goes out at whatever it goes out. You could figure that underwriting fees are going to be anywhere from 4 to 7.5%. Okay. Now, depending on the size, the bigger the offering, the lower the percentage of cost. The smaller the offering, the higher the percentage. These are all negotiated numbers, right? So, that's going to include a fee or a commission that you're going to pay the banker, but you've got legal fees, audit fees, you've got printing fees, you've got SEC filing fees, you've got a whole bunch of different fees that you need to pay, okay, along the way, okay? So we can negotiate, right? So what I was looking for before, we can negotiate a guaranteed or a fixed underwriting, or we can do a best efforts. negotiated, the investment banker is at risk, best efforts, the company is at risk, okay? When there's a standby underwriting, it's usually done for what are called preemptive rights. Does anybody know what preemptive rights are? Preemptive rights? It's not in the book anywhere. Preemptive rights? It's probably in the book. Okay, preemptive rights are rights that existing shareholders would have that essentially guarantee them that they will not be diluted. In other words, I own 10% of the stock in the company. The company needs to raise additional capital. They are going to issue, they're going to double the number of shares outstanding. Preemptive rights, if they exist within the company bylaws, and in this country, most companies grant their shareholders preemptive rights, okay? You're given the opportunity to go out there and purchase the number of shares that would keep your percentage ownership intact. That doesn't mean you have to take it. A lot of times people don't take it, but in that rights offering, you're given that opportunity, okay? And so what happens is when a company has to go out there and they do a preemptive rights offering, they do a rights offering, they do raise additional capital, an investment banker will come in and say, we will buy from you what isn't subscribed. Okay? We'll buy from you what isn't subscribed by your existing shareholders. So kind of a negotiated, but really only related to the rights issuances. Okay? So that's basically the underwriting process. Now, there's a huge sort of asymmetry here, right? That one needs to contemplate, because what happens is, in a way, if you're management or existing ownership, you may deem a negotiated underwriting to be the most advantageous for you. Why? Well, you have no risk. You know what's coming. But let's take a look at a couple of real-life scenarios. LinkedIn went out at 15. What was the first trade done at? Does anybody remember? LinkedIn's part of like Microsoft now, I think. I don't know if that deal's closed or not. I think it has. But, what did LinkedIn close at that first day? Anybody remember? Like 99 or something like that. Boom. Now my question to you is, I think it's already closed. Hello, Monica. I think that's closed already. Microsoft bought it. I mean, that thing wound up going up to 200 and something, and then it went down. But is there something wrong with this?
Yeah,
What's wrong with that?
that's a potentially mispriced asset.
Well, it's not mispriced. Somebody kept a lot of money on their side of the table, because the underwriter bought it at 15, but you don't know what he sold it at. But it was more than 15. Plus he probably kept a bunch of shares. So now if you're management or an existing shareholder, how good do you feel? Not so good, right? And so in this whole underwriting process, there's a sort of asymmetry of knowledge or information that the underwriter has that management doesn't have. So the process of underwriting is something that's called, book running, okay? So what happens, okay? So what happens is, you don't just go like shop for, you don't just call up a banker and say, hey, I want to go public, okay? I mean, there's a process that, takes time, and you gotta, so when you're in business, it's your job to know bankers that track your industry. Just like if you're a banker, it's your job to know the big companies in a particular industry. For example, when I worked at Florida East Coast, we didn't necessarily contemplate doing a transaction, but we had a relationship with Morgan Stanley. and it was a relationship that we'd had for some time. Prior to my working at the company, there had been a relationship with DLJ, with Donaldson, Lufkin, Genrat. And in fact, the people that bought us from Fortress, those guys were ex-DLJ guys that had gone to Fortress, and so they knew our company. But, so, you know, I remember for 2 years prior to doing any deal, we were meeting with Morgan Stanley periodically on a variety of different possibilities, right? So they might bring deals that they knew were out there to the table. They may talk to us about ideas that they have about how do we unlock value. They may come to us with, you know, financing or joint venture opportunities, okay? And so their job, because we'll get later on, because they're innovators, they got to know the subset of industries, but it's your job to go out there and know people. You know, I'm in a deal with my brother. I told you he sells pretzels or whatever. You know, I think he's buying another 35 pretzel joints. You know, eventually he's going to get to a point where he'll have enough critical mass in the restaurants that he will need a banker. Now, you know, in his case, it'll probably be a regional banker. It's not a big enough deal to warrant, you know, one of the big guys. But it's his job to already have established a relationship with somebody that will either find a buyer in a private transaction, find another private equity group that is involved. So there's a private equity group there now, but that they can sell it to somebody else and may have a better synergy with it, may value it, you know, you know, to take it to the next level, or they could potentially take it public. And so you're always dealing with that. So you know, you've got this relationship, you know, you're coming, it's time to do a capital markets transaction. Let's say that it's an initial public offering. The investment banker comes in, he helps you model just like your discounted cash flow analysis in real estate. He comes back and says, hey, so what do we say? The financial asset is worth what? Nothing more, nothing less than the fair market value of its future cash flows, right? How do you estimate those? You do a forecast, you calculate your weighted average cost of capital, you discount that back, you arrive at a value. And now the underwriter says, hey, you know what? I like this deal. Let's do a negotiated underwriting. We can place 200 million shares at 15 bucks. I'll take it off your hands. So today you typically, big deals, you'll typically have like 2 lead bankers, okay? So they can split the deal. But basically, it just becomes like a pyramid. And these guys are basically, you know, building a book, right? So let's just say Credit Suisse and Goldman Sachs, right, are the lead underwriters on our issuance. And each one says, hey, of the 300 million shares, we're each taking 150 million. So they each take 150 million, right? And then they go and they say, okay, look, I'm dealing with SunTrust, and I'm going to deal with Morgan Stanley, okay? And then this guy says, Goldman says, okay, I'm going to deal with the Merrill Lynch guys, and I'm going to deal with the Raymond James guys, okay? And then this guy goes, oh, okay, yeah, great. Look, I'm going to deal with Sun Asset Management Company in Memphis, and I'm going to deal with HSBC International people, and you know, and everybody just starts kind of going somewhere, right, down to a ground level, and then it ultimately gets down to brokers, and they start dialing for dollars. Hey Jordan, I can get you in a deal. You want in? Everybody wants in on an IPO, right? Because you're buying at 15 and it's going to go out at 99, supposedly, right? So everybody wants in on the IPO. So what's happening while all that's going on? These guys know what the demand is. So management is going out with these guys, making presentations to institutional investors, wealthy families, family offices, things like that. And they know how many shares everybody wants. They know the allocation, but management doesn't know that. So these guys kind of control it. Yes, they assume some risk, but they've got some potential upside. Okay, and so there's some, in addition to their fee, they're going to hold on to a bit of the offering, because one of the jobs that they have after the issuance is done is they've got to maintain the liquidity for that issuance. Okay, so they've got to play the next 2, 3, 4 weeks, months, whatever it takes, buying or selling to try to get some stability in that price. So they always hold some shares back, and then they'll eventually place them, and if this goes up in value, obviously what they're holding, they bought at $15, is going to be worth a lot more. And in addition to that, they earned a fee for doing this. Okay? Make sense? Yep. As broker dealers, what's up? I mean, it's kind of self-explanatory, right? What is a broker and what is a dealer? What is a broker?
He runs the financial, the brokerage firm, in other words, the one that has the license to.
A broker runs a brokerage firm. Okay, yeah, okay. Tell me something I don't know.
He's got the license to run to sell the stocks.
Well, it doesn't have, it can be in anything. What is a broker? What's a food broker?
He's got the license to broker food.
So a broker has a license to broker.
You
Okay,
asked
what
the
is-
question between the broker.
I ask a stupid question, I get a stupid answer. Right? You ask dumb questions, you get
Between
it.
the broker and the dealer.
A broker,
You're a liaison between
a broker is an intermediary between a buyer and a seller. And the intermediary typically
What about the dealer?
earns a fee, but does not take title to the merchandise or the good being provided.
But that's what I said.
Okay, yeah, you gotta say that. Okay, so the food broker doesn't actually eat the food, he just sells it and earns a commission. Okay, so a broker is an intermediary. We have those in real estate. A guy will represent a seller, would potentially represent a buyer. In commercial real estate, we typically see only a seller represented, but you could have a buyer, but you've got somebody in the middle between a buyer and a seller earning a fee. What's a dealer? Thinking cars, what's a dealer? He buys for his book, for his account, and then sells from inventory. Okay, so you buy from Ford and then you sell to individuals. Okay? And you resell. Okay? You know, that could happen, and I mean, it doesn't really, I mean, way back when, maybe with real estate syndication, some people would buy units and then resell. You don't really see that in real estate. Unless somebody, I can tell you that home builders are dealers. They're not buying typically from other, they're typically building for their own book, okay? But then they're dealers in the sense that they control inventory and then will sell. So, investment banks are both brokers and dealers. They will represent buyers and sellers in transactions in exchange for a fee, but they will also operate, because they are no longer, they're not commercial banks, they're not bound by the restrictions of being able to invest in equity. They will own stocks and they'll make money. And how will they make money? They'll sell it at the ask and buy at the bid. If for no other reason, there's always a spread between bid and ask. Right? Right? And ask is always higher, and the bid is always lower. That's how auctions work, right? You know, everybody wants to work that way, right? So, just for an example, if I am a dealer, right, and you usually don't see, you know, part of this, it goes into a whole other class, and there was actually an article that, there's an article that somebody didn't pick that relates with REITs on this, and it talks about liquidity of a particular, marketability of a financial instrument. One of the things we talked about in value, marketability. Marketability defined by bid-ask spread. So the narrower the bid-ask spread, the more liquidity, the more depth there is in a market. Okay? The broader the bid-ask spread, what happens? The less liquidity, the less things trade, right? So, and you see this every day. Thinly traded stocks might have 50-cent difference between bid and ask. Very actively, heavily traded stocks will have a penny or less than a penny. Okay? But, so if you're a broker-dealer and you own 100 shares, you know, you're the intermediary, you'll come in and you'll say, okay, I'll buy your 100 shares, right? I'll pay you 1,900, and then the next guy comes and offers 20 and you'll sell it for 2,000, right? And you just made, you know, $100 on the transaction, okay? So, now, they can do this strictly as dealers, and we'll talk about that in a second, or they can function as a dealer after an initial public offering, okay, where they're holding on to certain stock, certain, you know, certain of the original issuance, and then they will be releasing it over time to keep the stock price, but also to make a profit, okay? So, as brokers, that's how we know them, you know, and sort of the discount guys at TD Ameritrade and the E-Trade and Fidelity and Schwab and all those guys. You used to call up a guy and say, hey, buy 100 shares or whatever. You know, now you do it online and it costs $4.95 a trade. Now it doesn't cost $4.95 a trade. Do you know why? Because those guys are playing here too, okay? You don't really know what the real bid is or what the real ask is. You're looking at a screen, okay? And depending on your level of sophistication and what kind of a client you are, you're going to have better pricing, okay? But on the face of it, you're paying $4.95 for a transaction. Okay, now there are dealers out there. I'll talk about dealers in a second when we get into the quote-driven market or the NASDAQ. We'll talk about dealers in a little broader sense, okay? So most investment banks also operate as brokers and dealers, okay? If I follow my notes, I think I go into advising from here, so I'm going to fall out of, yeah, so when we get, well, actually, I'm okay. So in addition to mergers and acquisitions that we talked about, right? Hey, that company I was showing when I got here, that REE that you know is it owns fiber or whatever. They're buying two large companies. Surely some investment bank brought them that opportunity and said, hey, we think you could do an off-market transaction for these guys. Or like in the case when we had our business, we did a very limited offering. We put an offering book together. It was sent out to about 15 or 20 pre-qualified buyers, and those were the only guys that were able to bid on it. Now, by same token, you could have these, you know, hostile takeovers, you know, where you could have private equity groups come in. They could be advised by a bank. You could have prearranged transactions in the public markets advised by a firm. There was one today in Europe. There's a big toll road operator called Abertis, which was approached by a big Italian toll road operator that's controlled by the Benetton family called, well, it used to be called Autostrada. I don't know what they're called now, but you know, some investment banker talked to another investment banker, probably when they were playing polo or something, you know, in Monaco or something, and so said, look, we're going to enter into a transaction. We don't have a value yet, but we're going to enter into a transaction with these guys. They want to buy us, okay? So in addition to that, they can also advise companies. I mentioned the one before, the Seadrill and North American Partners and Seadrill Partners. They could advise companies with restructurings, with refinancings, with recapitalizations, with bankruptcy proceedings, okay? So it's not just an advisor role to company in mergers and acquisition. It could also be in your capital structure or a recapitalization structure, okay? So you know, that's another way that they get involved. They could help management do an LBO. And what's an LBO? It's not a channel you watch on TV. That's HBO. LBO is what? Andre, you know what an LBO is. Come on, you read the book. A leveraged buyout. What's a leveraged buyout, you ask? Funny you ask. I have an answer for that. What's a leveraged buyout? Leveraged, lever, buy out. Okay, let's put them all together. Leverage buyout. What could that be? When somebody buys something with a lot of leverage,
A little money.
Great position to get it for a low price, I don't know.
no, you don't typically get it for a low price. That's why you
Oh,
need
see,
a
if
lot
I
of
got
leverage.
Oh,
They use debt to basically buy.
Typically, these LBOs are typically management buying out a business with very little equity and a lot of debt. So a capital structure that would be highly levered. So,
highly leveraged, okay, I get it now.
so when you take a look at this, it's going to have very little equity and a lot of debt. So a lot of leverage buyouts. You typically see management. Why would management enter into a leverage buyout? Why would management enter into a leverage buyout?
The current owners? Or
I said managers. I didn't say owners
or current managers
of a business.
of the business, because they're in a terrible position.
They're in a terrible
They
position.
have a lot of debt, I mean, not a lot of
Is
equity.
there-
I'd be
there-
interested in reading someone else that could put me in a better position.
But they're managers. They may not even have equity.
Oh, then I don't know, what's their interest?
You saying with managers of a particular business?
Yeah.
Because they know the business inside and
Because
out.
they know the business, because they have intimate knowledge of the business. Because you may have an owner that either does not know what he has, you may have a marketplace that doesn't value what the business is. You went to look at something, it wasn't a piece of stock, it was a trailer home, right? A mobile, it was like a whole village. This guy, he doesn't want it, he wants to retire. He's 80-something years old, he doesn't want a trailer. He can't even drive a golf cart. How's he gonna drive that thing you showed me? He'll get a ticket. So, managers wanna retire. Owners wanna retire. Children don't want the business. Children want cash. You know, owner dies, children want cash. They don't want the headache of a business, okay? And so management is typically in the best position because they know the business. And now they've got an opportunity to then participate in the equity as well. And so a logical buyer, especially for closely held businesses, is management. And so an LBO situation, a leverage buyout, a management leverage buyout, advised by, structured by, facilitated by an investment bank is something that you typically see in the capital markets, okay? See, some of these concepts sort of overlap, so covered that, covered this, okay. We've just covered this one.
Wait, you said the investment bankers usually work maybe one or two areas of these functions, not.
No,
not all
they-
these functions.
No, most of them will do all of those.
They'll do everything.
Yeah, typically, yes. Okay? Most of these banks will typically, now, what you typically will have is that people will have specialized functions within a bank, okay? And so, for example, somebody who is, you know, in the underwriting side of the business is not, and there's inherent conflicts in being involved in the dealer network there or the broker network there, okay? So for example, let's think back to some of these conflicts. There was a guy on TV today. I can't remember his name now, but it was a name from like 2000. It was like one of these guys that like sort of went to purgatory for a lot of years, and all of a sudden he's come back to life. You know what purgatory is?
Yeah.
You're in between, okay? So you're not all the way down, okay? So this guy was somewhere down there in the netherworld, touching on, you know, the gates of Hades or whatever that's called. So, but he's not come back to life. Somebody prayed and got him back. But there's a guy named Henry Blodgett. Do you guys remember that guy? Henry Blodgett, does that ring a bell? So Henry Blodgett was a guy that worked at, if I'm not mistaken, Merrill Lynch. Merrill Lynch. So Henry Blodgett was a big telecom banker at Merrill Lynch. So he was taking all these companies public. But what's happening is he was then becoming like, he was like going on the board of the companies. or taking a pseudo position, not public, but he was helping, you know, sort of like he'd go to the board meetings. But then he was going to all the research guys and all the brokers in the company, and they were peddling whatever it was that he was selling, and it was all junk. Now, a good friend of mine in Spain worked at Merrill Lynch at the time, and I remember they came, the entire international network of Merrill Lynch met at a hotel in Key Biscayne. I'm going to say it's 2002, 2003, and they were pissed because they'd lost a lot of money for their clients because the guys that had underwritten the deals and told them what a great business it was, right? Turned out what they sold was a bag of doo-doo. And all these clients lost money, and so there is a sort of difference or distinction. There's a like a off switch, you know. Or okay, so these guys have different roles, okay, and then just it's different expertise, okay. We've covered this one as well. Yeah, what we didn't cover is one of the things that they can also help you with as an advisor is how not to be taken over. So we talked about takeovers, but they can also advise you on how not to be taken over. So how do they, you know, do you put a poison pill? You know, how do you buttress your shareholder base with friendly people? You know, how do you make, you know, sort of, you know, intelligent decisions to keep the guy from Alcoa. So this guy built, he spent 15 years at Alcoa. He orchestrated a separation of the company, and he got ousted yesterday by some activist hedge fund named Elliott Asset Management. You know, they had it out for the guy, and they went in there, and so the guy's like, okay, you know, white flag, I'm done. You know, I already did all my work. So they'll also help you with, you know, sort of how not to be taken over or how to structure a business shareholder friendly so that you'll have the support, right? And not be affected by those people. When we talk about innovation, let me jump to innovation for a second. So we talk about innovation, we've talked about this, we've talked about the sort of push-pull of regulation and innovation, okay? And, you know, along those lines, some of the things we've talked about and we'll continue to talk about in this class have come from the investment banking community in response to existing regulations. So for example, things like securitization, which we'll talk a little bit more about in the next class. You know, securitization comes out of Solomon Brothers, you know, back in the late 70s or whatever, you know. Money market funds come out of Merrill Lynch in the 1970s, okay, those now accounts and things like that, okay. Zero coupon bonds, stripping, recomposition, inflation index bonds, all those are responses, okay, to needs in the marketplace and or to obviate or bypass, you know, existing regulation, okay. And so as bankers that have clients that are creating products because they earn fees, okay, they earn fees, they're always, you know, dreaming up, you know, structured finance products, you know, there's always, you know, derivatives, whatever, okay? Swaps, and so, anyway, okay? Did we talk about derivatives at all? I'm not going to spend a lot of time on it. I just want to, so, what are derivatives? In the context of a capital markets class, I mean, they may have something else under the Merriam-Webster. It may mean something else. I don't know. Derivatives.
Contracts based on an asset's price.
So they are financial instruments, okay, whose value derives from something else. The underlying value is derived from something else. When we talk about derivatives, and this all sort of flows from, you know, this whole financial innovation, okay? We typically talk about 4 types of derivatives, okay? And it really starts with forward contracts, okay? And then it evolves from there. So, what's a forward contract? it could be,
Should be, you could
to,
do-
if somebody's buying, somebody's selling, so it is a contract to buy or sell a stipulated item at a stipulated price at some point in the future.
Yeah.
Why would someone employ a forward contract?
If you anticipate that the price is gonna go,
What if you don't anticipate? What if you don't care?
what do you mean, okay?
Well, to mitigate or hedge against business risk.
You're gonna mitigate or hedge risk, okay? So, let's take a very primary example. I'm a farmer. I grow wheat, okay? What are my concerns? What are my concerns? Do I have enough fertilizer? Is it hot? Is it gonna rain? Right? Are there bugs? Am I gonna get sick and be able, is my tractor gonna work? That's my problem, right? I don't wanna look out 120 days later and worry about what the price of my wheat is. I wanna have that problem solved, okay? And so, what the farmer's gonna do to hedge all that risk or mitigate all that risk and focus on what he knows how to do, he's gonna enter into a forward contract with who? Wonder Bread. Somebody who makes bread. Why? What do they care about? Well, what do they care about? The plastic for the bags, right? The regulation on my plant. Are my employees gonna show up, right? Can I buy yeast? You know, or whatever other problems they've got, right? What they don't want to worry about is, how am I going to get my supply of wheat and how much is it going to cost? So they're happy to also hedge or mitigate their risk by fixing a particular quantity at a particular price. Okay? And that's what a forward contract is. So you typically, sort of, the evolution of the forward contracts are needs between buyers and sellers. Typically we see this with commodities, okay? Between buyers and sellers who wish to mitigate their risk. Okay? Now, I'll get to you in a second, Alexandra. Typically and historically, these are over-the-counter transactions. I enter into a contract with you. You know, it might be 5,000 bushels with you, it might be 15,000 bushels with you, okay? And so these are sort of non-standard, non-exchange traded direct agreements that exist between buyers and sellers. Or, if we want to say, hedgers and speculators, okay? Hedgers and speculators. Okay, what's your question, Alexandra?
How does that, for any product, affect the market value? I mean, do you ever in your mind, have you ever seen where there's a huge skew between the proposed future forward price as opposed to the actual market value when that time comes? I mean, that seems.
It happens all the time.
Yeah, that's.
It happens all the time, and
incredibly
so,
flawed.
well, but listen, let's take a look at a realistic one that you read all the time. Airlines don't know what the cost of fuel is, and fuel is, if not their largest, one of their largest items, expense items. So what do? They enter into, so we're going to go to the next evolution of a derivative, okay? But they will enter into a contract where they will agree to buy a certain amount of fuel at a fixed amount, which may be higher or lower. Right now, they may pray. So these things coming off, they may be pay and take, right? So it's like you got to pay and you got to take. But maybe it's just an we'll talk about a different one. It could be an option agreement in this scenario too, okay? But this is the base. This is the base for the modern iteration of derivatives, okay? That somebody wants to hedge, because what happens if the crop is really good? One second. Let's say that today, what day is today? 4/18, right? a bushel of wheat is selling for, I have no idea, $10. I have no idea, I don't follow commodities at all, okay? Okay, it's selling for $10. Let's just say, okay? Let's say that the growing conditions are ideal,
And everybody grows and it goes down to
and we have a record bumper crop. What do you think it's going to be selling for on July 18th?
$5.
Yeah, or 3. And it might cost the farmer 7 to produce it. I might say, you know what? I'll book the sale now because I know I got a $3 profit rather than waiting until I get here and having to sell it to lose $4. Because if he knows that it's going to cost 7 to produce, and he knows that the market price is 3, what do you think he's going to do?
Sell it at first.
No, he's not going to grow anything.
Well, I was saying do the forward agreement.
Well, I mean, under this scenario, if it costs him 7 and the market price is 3, he's not going to produce. It's not going to produce. That happens with oil. If it costs you $50 to take oil out of the ground and the market price is 20, what happened a year and a half ago? People stopped drilling. Supply went down. Prices went up. Prices now went up to 50. What's happening with all the shale and all that? People are starting to drill it again. Okay? So, but then the guy who's drilling it is going to look down the line and take, so he's going to hedge his risk. Now, these are all sort of, forward contracts are over the counter. So they're one-off contracts, they're not standardized. So the next iteration, the financial innovation of this is futures. So futures contracts are like forward contracts, but they are standardized as to quantity, and they trade on exchanges. I'm sorry? Oil, wheat, pork bellies, cocoa.
Can you repeat that? Standardized on what?
They are standardized and they trade on an exchange. Now there are several exchanges that deal with derivatives. The biggest one is the CME Group, the Chicago Mercantile Exchange. But there's a whole bunch of other, little exchanges. Again, that's what I'm telling you, there's a lot of innovation in this area. And so anyway, so the futures contract is a standardization of this where there is going to be a specific definition of the quantity and the specifications and the delivery dates for each specific commodity or each specific item. So you're going to tell me, oh, well, give me an example. Okay, since I don't do commodities, I can't tell you. But for example, it might be a standard. You want me to look it up? I'm not even going to bother looking it up. It doesn't matter. You can go to the CME website, and for every commodity, you can see what makes up a standard contract. Okay, but you're going to see it might be 1,000 bushels of wheat. It might be 1,000 troy ounces of silver. It might be 64 barrels of oil. Okay, so or oil is a barrel. So every specific commodity is going to have a standard quantity, okay? And that contract is also going to have fixed expiration dates. Fixed expiration dates, okay? And so in those expiration dates, the contracts, become due. Now, in real life and future contracts, you typically don't take possession of the goods. You're just using these future contracts to mirror or hedge this position. So you're going to produce and sell at whatever the market value is, but you will have hedged by entering into a futures contract on an exchange, and a couple of days before it comes due, if you were long, you close your position, you sell. If you were short, you close your position by buying. So What's the difference between long and short?
Long
One's
means
bigger than-
you're making a profit, you're making
Long-
more than what you expected.
Long
Short-
is
short you lose
more than
money.
short, right?
Yeah,
Long,
exactly.
short. Okay, no, come again now.
Long is if you achieve the objective of your
No,
the expected price of
No.
No?
Long is basically buying, short and selling. That's the way I would
okay.
sum it up really quickly, but.
Long, when you are long, you're optimistic. You're expecting prices to
Go up.
go up. And so you typically buy. Because since it's going to go up, you're buying low and you're selling high.
The easiest way I used to look at it is you're going long, so.
Yeah, so long positions are associated with buying typically. Short is what is your expectation?
It's gonna go down.
Prices are going to go down. And so prices are going to go down, what are you going to do?
So.
You're going to sell. Well, how can I sell if I don't own it? Well, don't worry about it. That doesn't really matter. You can. You can, okay? Okay? But you sell. Why? Because you're selling high and collecting a lot of money, and then when you're closing the contract, you're buying at a lower price. So you sold for $1,000 and you put $1,000 in your pocket. The price went down to $800. You buy at $800 and you just made $200. So you can make money whether things are going up or they're going down, depending on how you look at it. Now, you didn't know any of this stuff, but if you're intrigued, you need to read about this. You need to read about this stuff, okay? Because, it's a way to make a living. Now, do these future contracts exist in real estate? The answer is yes, they do. Yes, they do. I haven't looked to see. It's a bunch of different contracts out there. Look, so the basic contracts here go back to the commodities, but the people started innovating and have created all kinds of gazillions of different, contracts. I saw one the other day. I might have printed it, but I saw one the other day that is an. So this is an over-the-counter agreement, okay? It's an over-the-counter agreement that tracks an index of certain CMBS securities that were issued during a particular period in time. So if you want to hedge your position, you can buy or sell that index. But there's stuff that tracks the weather, number of heating days in a month. Why would you want to do that? Well, because you might have a heavy consumption of fuel or electricity and you want to hedge. Okay? In real estate, there are future contracts that track the major indices of public equities out there. So the REE indices and the international indices will have future contracts. So if you own REITs and you want to hedge, so I have $1 million in REITs. I'm long, but I want to hedge that risk. Well, what can I do? I can sell short some of the index futures for a period of time, because if it goes down, I don't liquidate my portfolio. My portfolio goes down, but I make money in my futures account, hopefully to offset it. Okay? Now, I'm not going to get into how many contracts do you buy. That depends on the size of the contracts, and it depends how much of the portfolio you want to hedge. Okay? But, so indices, on the residential side, the Case-Shiller Index of residential values in a bunch of different markets. I don't think in all of the markets, but in most of the major markets, there's future contracts there. Now, why would you want to hedge that? I could argue if you're a developer, in one of those, you're a home builder in one of those markets, you may want to hedge what your future deliveries are. The reality is that a lot of people just speculate. And the difference between a hedger and a speculator is what?
The hedger is calculating his risk, and the speculator is essentially betting on it.
Yeah.
And what happens when you bet?
You,
You're playing a game of chance, right? And so kind of, I think empirically what I remember reading, and this kind of, it sort of holds true is, at least in my personal experience, is if you're a hedger with futures, you tend to do well because you know your business and you're mitigating the risk of your business. So you may not make as much of a gain because you've kind of capped your upside, but by capping your upside, you've capped your downside.
Right.
Or there's a cost to capping that downside. And it says if you're a professional speculator, so you are a financial professional that understands the supply and demand paradigms, right? If you know really what's happening with oil, right? If you really understand what, what's coming online and what's going offline and what the demand metrics look like, you might be able to make some money. And then the speculator, which is the individual that thinks he knows all this stuff and goes and buys all these contracts, loses their shirt. Okay, and I think didn't I say here in class the other day, a friend of mine lost $60,000 in a day or whatever? That's a speculator. That's a guy that one day heard something and he said, oh, I think I'm going to sell that because, it's going to go down or something, and it went up. Okay? So those are futures. Now there's a couple of other sort of derivative contracts. They'll make more sense to you. Options. CBOP, the Chicago Board of CBOT of Trade. Okay, so what are options? Options are contracts that give you rights.
I thought it was somewhere under futures.
No, but they're different. They're different.
Okay.
They're different. So I can enter into a future contract to buy this, right? Or I can enter into an option that, given certain conditions, I pay a premium, and that premium gives me a right to do something. Now, typically, a call option gives you a right to buy, okay? And a put option gives you a right to sell.
Okay, so futures, you're already locked up with quantity, time, and
Price.
commodity, the price, and all that stuff. Option is just the option. It's just the
Well, no, because so with options, you typically see that with stocks,
yeah.
and those are standard contracts. Typically, each contract is 100 shares of the underlying, okay? And so you typically have calls and you have puts.
Right.
So so let's just say I sell you a call option. You pay me $1, and that gives you a right to buy the stock at a particular price. So you could say a call is kind of like when you want to be long, you can buy a call.
I understand that. I'm just trying to understand the difference between the option and the future.
Hold on a second. I'm going there. So a call option, or if you buy a call option, it's kind of like wanting to go long or buying. So, for example, you pay me a premium, I'm just making it up, to buy Helmerich and Payne, this say $1, you're going to pay $1, and that gives you a right on, so again, this has expirations, fixed expirations on November 17th, November of 2017, to buy this stock at 43. Okay? What's it trading at today?
It could be 27, let's say.
Well, if it's trading at 27, would you likely pay $1 to buy it at 43?
If it's trading today at 27.
No, you'd probably pay a lot less. But anyway, so realistically, let's make it closer.
Okay.
You can buy it on May 15th for 43. What do you realistically think it's going to be trading for today? I don't know, maybe 41? maybe 41? You know, maybe 41, right? So, listen, I'm not going to get into the Black-Scholes model. There are several factors that ultimately try to explain what the premium on an option is, okay? But there's obviously going to be a relationship to price, okay? To the underlying price today, okay? Time has something to do with it. Volatility has something to do with it, okay? You probably have heard the VIX. Have you guys heard the VIX? So Black-Scholes is a model that tries to explain this. One of the components of Black-Scholes, one of the explanations of options premiums is volatility, standard deviation, right? So the VIX measures the component of volatility on the options contracts being sold in the market. So it's the investor's perception of the anticipated volatility. And when that index goes up, the investors are expecting a lot of volatility, and a lot of volatility is what? Risk, right? And typically risk is what? Downside when we're concerned with it, okay? So when you see markets going down, you typically see that VIX index, the fear index go up, okay? But anyway, we don't need to get into that. So that gives you a right. Now, if come May 15th, the stock is trading at 42, what happens?
You're still making a little bit of money.
Who's you? You just lost $1.
Yeah, but I mean, if I bought it, I have the right to buy it.
You cancel your option at that point, no?
Well, it just expires.
Yeah, that's it.
It expires.
Because
So
then
you
can
paid
take
me
the
$1.
price.
Okay, right.
So I came out winning. I sold the call option, okay? And I came out winning. I collected a premium, and I didn't have to do anything. If the stock goes up to 45, what happens?
Maybe it's
Oh,
close.
You call it. So you paid me $1, and how much did you make? $2.
$2, yeah.
Okay? And so you made $1 net. And what did I make?
You make your
I made $1.
Yeah.
Okay? So we both won in that scenario. So in a call option, you paid for the right to buy the stock at a certain price. Yes, Alexandra?
Is selling a call option almost the same concept as like a stop loss or?
No. So I'll go over stop losses in a little bit, okay? No, I'll go over stop losses in a little bit, okay? Puts are the other way. You pay me, you're expecting the stock to go down, okay? So it's at 45, and you're going to pay me $1 to buy it from you at 43, okay? So if the stock goes down to 41, right? You've paid me $1, but I got to pay you 43, okay? So I collected $1 for the premium, but I just lost 2 now because, okay, I had to pay 43 and the stock's only worth 41. Okay? But again, there's people that have opinions. People think things are going to go up. People think that things are going to go down. And so you always find someone to play it.
When you say you lose 2 between the 41 and 43.
Yeah, because the
No,
stock's
you-
worth 41 and I had
Yeah,
to buy
I-
it from you at 43.
I understand that, but when you say I have to buy, are you the bank, the investment bank has to buy?
No. You're doing this with another counterparty.
Oh, right.
You don't know who that is. You're just doing it on an exchange.
Okay.
There's a clearinghouse.
Okay.
Okay? So you're on your screen. You don't know who the guy who lost is.
Right.
Okay? And then the last thing, which are again pretty much over the counter, which is probably the one that has the largest notional value, is swaps. And swaps are what? I wasn't even going to cover any of this stuff, but this stuff is interesting, isn't it? What are swaps? Well, it's when we exchange positions. So A typical place to do a swap would, for example, be with what, interest rates? We talked the other day when one of us has a qualitative advantage in getting a fixed interest rate, for example, and somebody doesn't, I may be willing, for whatever motivation I may have, which could be a fee, to exchange my fixed interest rate position for your variable interest rate position. Okay, so the one who has the advantage sells to the one who has the disadvantage in exchange for a fee. Okay, you can see it with currencies. So currencies and interest rates are typically where you see swaps. Okay. So those are derivatives, specialized. They use a lot of leverage, a lot of leverage. You can make a lot of money, you can lose a lot of money. You have to be approved to trade in them. So you could have a typical normal margin account at a brokerage house, but they will not just let you trade derivatives. Okay, so you've got, and curiously, at my normal account at Schwab, I can't trade derivatives. Now, I can get it, but I've chosen not to. Whenever I do any of this stuff, I do it in an account I have at Options Express, and I have a limited amount of money there so that I don't ever get crazy. And I can tell you, I'll tell you, I opened this account probably 6 years ago. And so if I started at 100, the history has been, it's gone down to like 60. It's kind of gotten itself up to like 80. It's kind of gone to like 70. And then it went up to like 120. And now it's at like 92.9 today. Okay, over a course of 6 years. And these moves, I mean, like that move was like 3 days. Okay, I mean, you can't, this isn't for, like, you shouldn't have positions open for a long time there. Okay, so, for example, I've only, like in the last year, I've only used it for 2 things, okay, and I can tell you why I would use them. One, when I'm anticipating a big market move, and I don't have time to go out and buy stocks, or build a portfolio, or sell a portfolio, buying an index, like an S&P index, gives you access very quickly to the market exposure. Give me an example. It's election night. It's 11 o'clock. Oh my God, Trump's going to win. The S&Ps are down 105 points. I think I got to buy. 9 o'clock in the morning, it's up like 20. So, you know, like $17,000 overnight. Boom. Yeah, but you can lose it like that, okay? You can lose it like that. So, quick. The markets are open 24 hours a day, okay? A better one. You think the market's due for a correction, but it takes time to build a portfolio, and you don't want to sell it. You can't just be buying and selling 50 stocks every day. So maybe so you could buy a put. You could use options. I don't use options. I don't buy puts. I will sell the index short. And then you got to monitor that every day, and you got to have a stop loss. I'll talk about a stop loss. You got to, because if your hunch is off, you gotta cut it. Okay, you gotta cut it. But hopefully, what you're hoping to do is offset with gains what your portfolio is losing. Okay. And then the other thing, lately I've been doing what are called covered calls. And I've done some of those, and I think I'm going to do 2 or 3 more. And so when you think a stock is not really going to go up or down, and maybe it pays a nice dividend, what you do is you buy the stock, and you sell a call option. So you collect a little bit of premium. So for example, you buy the stock, and the stock costs you 40, and maybe you sell call options, and maybe it reduces the cost by 50 cents a share, just to say something. Okay? So now the net cost is $39.50. Now, sure, by selling that option, somebody could call the stock on you. right? But you're not expecting it to really go up or down, and you want to hold it. So what happens is maybe the stock gets called at 42. Well, if it never gets to 42 and the option expires, what happens? You collect your premium. Well, you collect it at day one. You keep the premium, and now what do? You write another call option. And so all you're doing is enhancing the dividend. And if it goes up to 42 and they called it on you, guess what? You made $2. So, you know, you got tapped out, but in a good way. Plus you lowered your basis, okay? So, but you got to do that with stocks that you're expecting aren't really going to go up a lot or down a lot, so that you can keep writing. There's some REITs out there, there's some mutual funds and ETFs that do these buy right things, that they'll take, you know, sort of large value, slow moving stocks, dividend payers, and they have a portfolio. There's like an index that actually does this buy right, and you can just buy, and the history is it gets you a little bit more than what the dividend yield is what it does. Okay, you don't get a lot of capital appreciation. You kind of get the dividend, and you're collecting these little premiums, you know. So anyway, but anyway, just the history, you can see I don't really do a lot of transactions. We're very volatile. Boom, boom. Okay, so you don't you really want to have stops on this. And I had a student from 2 or 3 terms ago. It kind of pissed me off because the guy wrote me, he goes, "Hey, do you think it's a good time to short whatever?" And so I wrote him, you know, I spent an hour sending him a response. I never even got a thank you. I never even got an acknowledgement that he got my response. But my point was, you know, listen, take a look at this, this, and this, because I'm not sure that you're right. But if you're right, and if you want to sell short, make sure you've got a stop loss, because what you don't want is that loss to just keep growing. Okay, so you got to be a big boy and say, I'm prepared. If I'm wrong, I'm prepared to lose X. And when you get to X, you got to take your lumps. You got to take the loss. You take the loss, you yell, and then you got to forget about it. And then because otherwise you just. I used to have coffee with a guy every morning. He sold some bank stock, short one, and when he goes, I'm down like $40,000, and I'm like, Jack. And he's like, yeah, but I never had the stomach to sell it. I go, yeah, but you've lost the money already. No, but I'm hoping it changes tomorrow, you know. So I think eventually, he got back to like -20, and then I was like, okay, you know, like, okay, I'm good, okay. We'll talk about securitizations. That's part of innovation. We'll talk about that in another class. Asset management is so asset management is you know, like what people call wealth management or private banking. It's, you know, you're a wealthy guy. You give some specialized guy at the investment bank your money. He might be a broker, okay? At the end of the day, he is a broker, but he's more sophisticated than just a, he doesn't, it's what used to be called a broker, now he's called a wealth manager, okay? So what he does is he helps you with your investment, and he finds products that are appropriate for you. I say he, it could be she, and they could help you get into products that maybe aren't available to you in the market, you know, private offerings, hedge funds, private REITs, things like that, okay? And so investment banks are huge asset management businesses, huge. Because not only are they doing this for individuals, they're doing this for institutions. I remember one of the big institutional partners we worked with was JP Morgan. And so, you know, JP Morgan had, you know, huge real estate exposure. But when you took a look at their corporate organizational chart, and you looked at, so there was the bank, and then there was a little division called asset management, and then within asset management there was real estate, you know, and it was like, you know, 50 guys, you know, out of 100,000 that worked at this bank, but they were managing billions and billions of dollars because their clients are the pension funds, you know, the major institutions, the endowments. They need professional management. So we can think of asset management at these banks as the wealthy individual who has a broker, but we can also think of it as the asset management function for the large institutional or pension funds that need professional management, okay? And so that's basically investment banks. Now, merchant banking activities. So merchant banking activities are when financial institutions, when these financial institutions trade on their own account. So I don't know if you noticed, I think one day last week, there were 2 or 3 banks announced and they made a bunch of money trading bonds last quarter. And then this morning Goldman Sachs announced and they missed their anticipated earnings by a couple of cents because they did not make what they thought they were going to make trading bonds. And so, so merchant banking activities, you know, they may be loans. So a lot of times banks will make a big bridge loan in anticipation of being able to facilitate or broker a loan for a large merger and acquisition transaction. But typically it's buying and selling on a speculative basis of financial instruments, okay? And because they are not a commercial bank, right, within the investment banking realm of the institution, they can play with their own capital, okay? Now, I don't want to say blow, I'm going to go quickly through this because this is the area that I said is really changing quite a bit with technology, okay? So, primary and secondary markets. So, we've kind of talked about that, and we've kind of said that a primary market is an initial transaction between a company and a shareholder. So it's when a company raises money, be equity or it could be debt. A secondary market is the broad term for any transaction that exists between a shareholder or a debt holder and another equity holder or debt holder. So they have nothing to do with the company. Okay, so basically that's what facilitates or creates a liquidity that facilitates or allows the primary markets to exist. Because if there was not a secondary market, not a lot of people would engage in primary market transactions, because there's got to be a day that you buy and there's got to be a day that you sell, right? As you're going to tell us in a little bit, right? Mm-hmm. So it's not just with real estate, it's with securities as well. Now, in order to have primary and secondary market transactions in this country, we need to follow the law. And the law, going back to some of the financial or financially related laws that were passed after the Depression in 1929, if you're going to sell securities to the market in a primary market transaction, you must comply with the requirements that force you to have what's called an initial registration statement. So you must register those securities with Securities and Exchange Commission. What does that mean? It means you got to put a book together like this. Typically with stock, it's an S1. Okay, you need to do an S1. It's a big thing. It talks about your company. It talks about all the risk factors in your company. It talks about your financial history and results. It talks about the use of proceeds. It talks about what your business is all about. It includes your financial statement. If there's some sort